My name is Darren Carlett, and I'm the Managing Director of Dual Edge Research. Dual Edge publishes 2 weekly newsletters. The first is a stock and option strategy, which is covered in the Bull Strangle newsletter. The second is a commodity futures spread strategy that is covered in the Smart Spreads newsletter. This video is dedicated to the Bull Strangle strategy and is the second of 4 videos. So this is video 2 in a 4 video series. If you haven't seen video 1, I suggest that you start there. In that video, we provided a high-level overview. We got into some pretty specific examples on options and explained how they work. Talked a lot about intrinsic versus time value. And I think one of the key elements of that video was talking about buying versus selling premium. And quick recap, we are sellers of premium, and sellers typically have a very positive earnings expectation. I'll talk a little bit more about what's in this video in a moment, but looking forward, video 3 really gets into risk optimization. We go through several risk rules. We do introduce some strategy variations. I trade the more aggressive, what I consider to be kind of the core foundation of this strategy, but there are variations which does reduce your risk for those that have a little bit less risk tolerance. And then we get into a market environment analysis that I've completed using data back-tested back to 1993 through 2024, so 31 years of data. And then the final video, video 4, will be details of the newsletter. And literally, we're going to just kind of walk you through a typical newsletter, show you all the information that's in there. It includes a market recap every week. We'll go through an open trade update where we go through charts of all the trades that are currently open. We'll introduce the watch list candidates, which is usually around 20 every week, of which we're going to pick, for my personal account, 5 trades. And then there is a performance summary where we're going through past performance on all trades that I've actually placed in my personal account, as well as an accounting of every one of the 20 or so stocks on the watch list. As I mentioned before, I'm really big on documenting performance. I'm sure you've seen commentators, pundits, market pundits who make bold claims, but then never come back and talk about any of their losers, right? You'll never see that in my newsletters. I will have full accounting on every trade that I place, and these are based off of actual fill prices in a personal account, as well as looking at, and I'm using, when I publish a watch list, I'm putting in the actual stock price and the option prices from the previous Friday. I then roll forward 4 Fridays later and put in how that closed. So we've got a great comparison on the historical performance of every stock listed on the watch list. All right, for video number 2, we're going to break this topic down into basically 3 parts. The first is playing the odds. And as we talked about, and this will just be a quick review, we're going to sell premium, right? We're going to be the banker, be the casino, however you want to put it. We're going to talk about how to construct a trade, and then we'll talk a little bit about determining the optimal strike price. Next, we'll get into stock picking, and this is the thing that I've called kind of the cornerstone of the whole strategy. If you pick great stocks, you're going to have a winning strategy regardless of what the market does. Now, I'm looking at it over time, not on an individual basis, because you're going to have some losers in there, but picking quality stocks that hold up under all conditions is very important. And we'll talk about the winning characteristics of a good stock. We'll talk about how I favor technical support. Again, I'm looking at support versus the high flyers. We are going to avoid earnings announcements. Like the plague, we do not want to be in the stock. Remember, we're going to be holding stocks for a 25-day period. We do not want an earnings announcement in the middle of that period. And then, of course, we're going to go through diversification again. And then we'll finish up with some tactics to kind of play it smart. We'll talk again about the expiration cycle. We're going to leverage weekly options and have a group of stocks and options that expire every Friday. We'll talk about lot sizing, and then we'll get into some trade management techniques. As mentioned in this section, we're going to talk about selling premium, trade construction, and determining the optimal strikes. Okay, so the first part of playing the odds is to sell premium. I use the analogy of being the casino. You could also think about it as being the banker. And this is a slide that I presented in video 1, but it just is very important element of this whole strategy is that we want to be sellers of premium. We are going to collect premium and profit from time decay. The source is going to be price stability and time decay. Our win percentage is going to be between 60 and 75%. And actually, I'm currently exceeding this 75% when you look at the totality of the stock, the calls sold, and the puts sold. But I like that range there. It gives me some wiggle room. And the average profit or loss is going to be small, consistent gains with the occasional large loss. By the way, if you're still not convinced that selling premium is the right strategy, I suggest that you go back to video 1 and go through that section again. Being a premium seller is a critical element of this strategy. All right, now let's go through trade construction. And to begin with, we are going to just focus on the covered call, naked put strategy. That's the strategy I also refer to as the Bull Strangle strategy. We will cover variations to that in detail a bit later in this video. But for right now, we're going to just kind of stick with the base trade construction. So every trade is going to start with buying 100 shares of stock. Now that's going to be in increments, right? So if you are targeting, say, $5,000 per trade, and you have a $10 stock, you're going to be looking to have 500 shares of stock to kind of get you to that increment that you're looking for, right? So remember earlier we talked about the range I use is from roughly $10 to $120, and I have a broad range of stocks every week on the watch list. I've mentioned that there's usually 20 on the watch list. There's going to be several in each different increment across the spectrum. So regardless of what your target investment level is, you're going to have watch list candidates that meets that. Okay, so we are buying in 100 share increments, and then we are going to sell a call above and a put below. Okay, now note that this is an out of the money call 4 weeks out. Every trade is initiated on a Monday, and we're selling, in most cases, a weekly call that expires 4 Fridays from then. Okay, so that's the basic trade construction. We're going to talk a little bit about how far out of the money on the next slide. But one thing that I think some people kind of get locked up in is that you have to understand that you will have stocks that blow right through your call strike price and close, quite frankly, way above the strike. And it's easy to look at that and say, oh my God, if I hadn't have sold the call, I would have gained, X amount. I had a stock not very long ago that I would have gained 60+% on the stock had I not sold the call. But keep in mind that this is the best case scenario is when it closes above your call strike price. You're going to keep all your premium for the call, and you're going to keep all the premium for the put. And yeah, you have capped your gains a bit. There's no doubt about that. And you have to think about it in terms of, again, I always go back to think about it in terms of 1,000,000 trades. Some portion of those 1,000,000 trades are going to be with stocks that blow way past the call strike. But keep in mind, this is the best case scenario, and be happy when it happens. Let's talk about determining the optimal strike price. So determining this near the money or out of the money is an individual decision. I think this is where there's some level of art versus science to this. And I think it's okay for there to be a little bit of a different strokes for different folks when it comes to this. I'll tell you kind of the pros and cons of a couple different scenarios. I'll walk you through exactly how I try to trade it, but I will tell you that I don't think there's a concrete, perfect answer to this, and using some individual discretion is absolutely advised. So let's start by talking about setting the strike price near the money. The pros to this is that you are going to collect a higher premium income because these options have higher extrinsic value, which again, I'm calling the time value, leading to more upfront income. They also have a higher probability of assignment. So you're more likely to sell your shares at the strike price, which is fine if you're happy exiting soon. Now, keep in mind, we're not looking to keep a stock through a whole wide range of cycles. In fact, because of earnings, sometimes you need to sell that, get out of that stock during one cycle and not have it and own it during the next cycle because they may be reporting earnings during that cycle. So we're looking at every stock on a one cycle basis. If we decide to keep it for a second cycle, that's kind of a separate decision. And then the third pro is that there is more downside cushion. The higher premium that you receive offers better protection against modest drops in the stock price. Remember, the option premium that you collect reduces your break-even point. So the more you collect, the lower the break-even point becomes. Now, the cons to setting your strike price near the money is you do limit your upside. Gains are capped quickly, and if the stock rallies significantly, you will miss out on most of that upside. Now, I talked about this on the previous slide. This is going to happen, and you're going to kick yourself when it happens, but I want to remind you that this is the best case scenario. And the other con is that a higher chance of having to sell your shares. If called away, you may face tax consequences or miss long-term gains. Now, I put this in here because this is a fact. We aren't looking for long-term gains on this strategy, okay, at all. This is not a consequence for me whatsoever. And if you're thinking about it in terms of the tax consequences, this strategy is probably not right for you. I will rarely hold a stock more than 2 cycles, which is 1/6 of the long-term gain. So we're not getting anywhere near long-term gains. And in fact, if you think about, and I'll talk more about earnings in a moment, but if you were going to hold a stock for a year, which gets you into the long-term requirement, you're going to hold that through 4 earning cycles, and that's absolutely violates one of our decision rules. Okay, so next let's talk about having the stock price far above the stock purchase price. So we're going to call this out of the money. Out of the money is a relative term. Actually, near the money is out of the money as well, but it's further out of the money, let's say. The pros to this is that you are going to have more upside potential. You get to keep more of that stock's gain before hitting the strike. You are going to have a lower assignment risk, which means obviously less chance that your stocks gets called away unless it rallies strongly. And you are still going to receive some premium, though smaller. And the premium does add to your return. Okay, so clearly there's a trade-off between the premium you're receiving and the amount of gain that you could potentially get from the stock price increase. The cons are lower premium, less income up front because the option has a lower extrinsic value, and you do have lower downside protection because, again, the smaller premium reduces that break-even point less than more premium. The rule of thumb is to use near the money calls when income is your top priority or you're willing to exit the stock soon. The other side of that is use far out of the money calls when you're bullish and want to hold the stock longer while still collecting modest income. Now, my 2 cents, our whole strategy is built on collecting premium income and exiting the stock early. So clearly, we are looking at the top part of this rule of thumb. Now, I do have a little bit of discretion when I'm trading for my personal account. I will give stocks with higher option premiums a bit more room than stocks with lower premiums. So for example, if I've got a stock with a 40% implied volatility. Now, implied volatility, it directly impacts how much option premium you receive. So a 40 is going to get you a much smaller amount of option premium than one with a 100% implied volatility. So when I'm trading one that's 40, I'm going to keep those strikes pretty tight. And when I'm trading one with 100 implied volatility, I'm going to loosen it up quite a bit. But remember, we have no intention of holding a stock long term. So this whole notion of trying to avoid long-term or short-term capital gains is not even a part of the equation. The next section in this video is around rock-solid stocks. As I've mentioned, this is what I believe to be the cornerstone of my whole Bull Strangle strategy. In this section, we will talk about winning characteristics. We're going to talk about technical support as a very important basis for stock selection. We'll talk about why avoiding earnings announcements is important. And then finally, we'll end with describing diversification tactics. We'll start with winning characteristics. I'll tell you that when I'm putting together the newsletter, I spend more time on stock selection than on any other portion of the newsletter. And this, of course, ties into the watch list and all the information that we provide in the watch list. But this process starts with a stock and ETF screen searches. And here is a kind of a partial list of the different searches that I complete. And I'm not going to go through these in a bunch of detail, but the bottom line is I'm using these searches to ensure that candidates have a positive technical reason to be traded. So after completing these searches, I'm going to end up with, in many cases, well over 100 initial candidates to start with. And I'll describe to you later in this section how I take that initial list of over 100 candidates and whittle it down to about 20 stocks to put on the watch list. But included in the search that is off to the left is these criteria on top of that. So this criteria applies to each one of these individual searches. So first of all, I'm wanting to understand if it has weekly options. And this is important during the non-monthly cycles. I'm looking for no earnings for the next 30 days, which takes me out beyond the end of the expiration cycle. Again, we do not want earnings announced while we're holding these positions. And I'll explain why that's important in this video as well. We want our open interest to be greater than 25,000 contracts, and I'll go into detail as to why that's important. I do screen for stocks to be in between $7.50 and $120. Now, I think earlier I said that 10 to 120 was kind of the range. I do in the initial search start off at 750. Many times I'm going to get rid of those under 10, but I don't want to exclude stocks until I've had a chance to kind of look them over. And then I do want the implied volatility to be greater than 35%. And of course, I'll describe implied volatility in just a minute. This criteria ensures candidates meet minimum stock price and option premium thresholds so that I have a good working list. Okay, so now I want to go through each of these different thresholds that are applied to my stock screens. And we're going to start with avoiding earnings announcements. So when a company announces earnings, volatility and uncertainty tend to increase for its stock due to a combination of expectation dynamics, new information, and emotional market reactions. So here's kind of a list of what tends to happen. So first we talk about kind of expectations versus reality. So before earnings, analysts and investors set expectations for key metrics like revenue, earnings per share, margins, and guidance. When these results deviate positively or negatively, it creates price gaps and increased trading volatility. So obviously a positive earnings surprise can lead to a rally. A negative surprise can lead to a sell-off. And even if they meet these expectations, generally a stock is also, or a company is going to also talk about forward earnings guidance. And this might disappoint. So even if you beat earnings, you might have negative guidance, which could cause a sell-off. So the second thing is around information asymmetry. Earnings releases often include detailed financials, management commentary, and forward-looking guidance. So, and this influx of news, fundamental information reshapes, investor valuation models, and forecasts quickly alter price assumptions. Next is the uncertainty leading up to the event. And the days leading up to earnings, implied volatility rises in the options market. Traders and investors hedge positions or speculate, and market participants brace for the event risk. This is why earnings season is often marked by elevated implied volatility. The fourth reason is kind of the aftermath volatility. Post-announcement, traders react not only to the number, but also the tone, outlook, and surprise. Large institutional orders may be placed or unwound, and volume spikes and intraday prices swings can widen. And finally, broader market sentiment. Earnings announcements can also reflect broader trends, which further amplifies uncertainty if investors extrapolate to entire sectors or markets. So in summary, earnings announcements inject new information into the market, which often challenges prior expectations and prompts rapid reassessment of a company's valuation. This leads to higher short-term volatility and increased uncertainty. The bottom line is every effort is made to avoid companies that are scheduled to announce earnings during the holding period of the trade. But be aware that earnings announcements dates are sometimes hard to pin down. I have frequently will use multiple sources. So I may see an earnings announcement on my initial screen, and then as I'm researching that trade, we'll find a different earnings announcement date. So be aware that earnings announcement dates are sometimes hard to pin down. And occasionally I have entered a trade believing that the earnings announcement date was outside of the expiration cycle, only to find out later that it is slightly inside. When that happens, I want to go ahead and stick with the trade, and then we'll try to exit it a couple days prior to the earnings announcement. The next threshold is open interest. In this slide, we'll talk about what it is and why it matters. So open interest refers to the total number of outstanding options contracts, calls, or puts that are currently active but have not yet been exercised, closed, or expired. It is reported per strike price and expiration date, and it resets to zero after expiration. Now, when I'm looking at open interest, I'm looking at total open interest, and I'm looking at across all the various different options that are out there. But the key thing is that it's a relative number, and the higher the open interest, the better, and the more certainty it creates. So an example of open interest, we'll use Apple again. It's a $200 stock with a call that's expiring in 3 weeks. The open interest, for example, is 20,000 contracts. This means that 2 million shares, which is that 20,000 contracts times 100 per contract, are tied up in open option positions. The high open interest, or OI, means strong activity, which is better for entering and exiting with minimal slippage. So why open interest matters really ties to the slippage that I just mentioned. Higher OI generally means more buyers and sellers, which leads to tighter bid-ask spreads and easier trade execution. So tighter bid-ask spreads increases price fill certainty. In other words, before you enter a trade, you pretty well know exactly what price you're going to get filled at if it's got a very tight bid-ask spread. And conversely, low open interest often results in wider bid-ask spreads, making trades more expensive or difficult to exit. So looser bid-ask spreads decreases price certainty. When opening a new trade, knowing the option premium to be received in relation to the current stock price is a very important factor to your decision. Therefore, knowing with more certainty what that option premium you're going to receive is a very important part of the decision-making process. Now let's talk about the final two thresholds, which are implied volatility and stock price. So what is implied volatility in options contracts? Implied volatility, many times expressed as IV, is the market's estimate on how much a stock might move in the future, which is expressed as an annualized percentage. In simple terms, higher IV, or implied volatility, equals higher option premiums because the markets expect larger moves. Why is this important? Receiving option premium is the primary basis of the strategy. So obviously receiving higher option premiums is something that is important to us. However, I'm looking to have a range of implied volatility for each given cycle. Now, I've mentioned a few times that I usually will open up 5 trades each cycle. 4 cycles are open at any given point in time, which means 20 stocks, right? I'm usually going to be looking for a 40% IV, a 60, an 80, and 100, roughly. You know what I mean? I'm spreading out the implied volatility. So yes, implied volatility higher is good. However, too much of a good thing can create way too much volatility in your portfolio. So I do like to spread that out. And then in terms of stock price, how does the stock price impact trade selection? Well, selling a covered call and naked put does require owning 100 shares of stock. So a higher stock price equals higher upfront capital. Now, a simple example, and I'm using the range that I use, 100 shares of a $10 stock is a $1,000 investment, whereas 100 shares of a $120 stock is a $12,000 investment. So there is obviously a big difference between the two. Now, you have more flexibility with these lower priced stocks if you have limited capital. So why it matters? A diversified portfolio means multiple open trades, and high stock prices limit how many trades you can maintain. Now, as with implied volatility, I'm generally looking for a range of stocks within my range. So my range is from 10 to 120. So I'm looking for maybe one $10 to $20 stock, one maybe 30 to 40, and so on. I don't want to overload my portfolio with just $10 stocks or just $120 stocks. Okay, now we get into what I would tell you my favorite part of the presentation is, and my favorite part of this whole strategy, which is getting down to the actual stock picking. Now, stock picking can be very subjective, and there are a bunch of different ways to pick a high quality stock. But I try to look at everything from a technical basis. Now, and I've learned that technical support is the best fit for the strategy that I have developed. So let's look at two different kinds of stocks and discuss the pros and cons for each. The first category is what I'm going to call a high flyer stock. These are rapidly rising, momentum-driven stocks. Examples would be NVIDIA or Tesla during their big runs. The pros are that they have strong momentum and they many times will outperform in a bullish market. They do have high breakout potential and can move aggressively after clearing resistance. They do attract a lot of institutional attention and may be driven by upgrades, earnings beats, or thematic trends like AI, artificial intelligence, EVs, etc. Now, we've talked about the fact that we avoid earnings announcements. So that's a factor that we try to engineer out of our trade selection. And they do many times represent market leadership and frequently represent innovation or growth leadership. Cons, they do have high volatility, which isn't necessarily a bad thing in and of itself, but fast gains can reverse sharply. And this is my number one reason why I like to avoid the high flyer stocks is that when the market does decide to sell off, these are typically the first to fall. Many times they become overvalued and may trade well above their intrinsic value or fundamental value. Many times they can become crowded trades when their popularity can lead to sharp sell-offs on bad news. And there is a danger of chasing the stock where you're buying late in the move, which can result in a very poor entry point. Now, on the other end are stocks that show strong support. And these stocks are repeatedly hold at or near key price levels, often viewed as low-risk technical entries. So the pros here is that the risk is generally more defined. The support levels often provide clear entry and stop loss zones. Now, we're not really concerned about stop loss levels because we're going to hold trades through their expiration date, but we do get very clear entry points for sure. There is a value opportunity often associated with basing or consolidation phases. There is a mean reversal potential. If it is a bit oversold, it may bounce towards its fair value. And typically these are less volatile, which may mean more or less erratic than the high flyers. Now, the cons are slower growth. They may lack strong catalyst or momentum. The support can break, and false bottoms are common in weak markets. They do have a little bit more limited attention, and they're less likely to draw institutional or retail hype. And they may be out of favor. Low support doesn't guarantee upward movement. Now, in summary, I think both categories can work with this strategy, but I have learned through experience, because I used to trade the high flyers when I first started trading this strategy, but I have learned that stocks with strong supports tends to fit our strategy the best. All right, here is an example, a visual example of what we're looking for. On the left is a high flyer stock. This high flyer is 12.8% above its first support level and almost 22% above its second support level. Now you could see this has got a great looking chart. Again, lower left to upper right. I mean, what's not to like about the stock? The problem is it's way ahead of any support levels. On the right is a stock that has strong support. Now, generally, you can see that this stock actually is going more from the upper left to the lower right, which you would normally view as not being a strong stock. But you can see that it started to bottom and it's now crossed several key support levels and now is going to be supported by, in this case, 3 different levels of support. The first level is and the second level are a combined 9.4% from the current price. So if the market starts to sell off, my learnings and observations have been these high flyers are going to fall much further than the ones with strong support. And on this next slide, we will show a very good example on how that might manifest. Okay, to illustrate really an observation that I've had over time between a high flyer versus a stock with strong support. And for this example, we're going to assume a $85 stock, and we're going to sell a call above for $4.50 and a put below for $4.50. Now, it's important to understand that the implied volatility on both trades is obviously the same given the parameters that I've just laid out. But in my observation, both have the same chance of increasing because of that, implied volatility. But again, in my observation, I feel like the high flyer is going to drop much more if the market sells off than the one with strong support, because there's nothing underneath the high flyer to keep it from falling, whereas you've got several support levels underneath the strong support. So if I look at the high flyer and assume 2 trades, one that goes up 10% and the other that drops 10%, we're going to make $1,100 on when it gains, but then we're going to lose $1,050 on the 10% drop, leaving a total profit on the 2 trades of just $50. Now, given the sharp sell-off in the 2 trades, coming out with a little bit of a gain really isn't a bad situation. But when you look at the strong support, and now we're going to look at a 5% increase and a 5% drop. And of course, we're going to hit maximum profitability with 5% increase, which gets us to the same $1,100 gain. However, note that the loss on a 5% drop is just $200. And so the gain across both trades is $900. Now that's quite a bit better than the $50. So again, this is a bit of a subjective analysis, obviously, but I can tell you from just trading these 2 different types of stocks, this has been an observation that I've come across repeatedly. The next area that we'll focus on is diversification. Now, there's a lot of complexity that can be added to this topic. There's correlations between various different market sectors, and some sectors do tend to move up and down together, and other sectors tend to lag behind. And when you look at the different phases of the market, a bull market, a recession, inflation and rate hikes, a late cycle expansion, this gets to be extremely complicated, and it's really beyond the scope of the newsletter to dive into this level of detail. The correlation does matter in sector investing because it does reduce portfolio volatility. If you're mixing low correlated sectors, they can create a smoother ride. It enhances diversification because it avoids overconcentration in sectors that rise and fall together. And it allows for strategic rotation, so you can shift between sectors as economic conditions change. Now, when I'm thinking about actually having a strategic rotation, I'm literally talking about overweighting maybe one more than usual. So my changes to just trying to stay broadly diversified is very, very minor. So think about diversification not in terms of how the sectors move together or don't move together, but just in terms of being diversified. Now, a good example of how diversification impacts your bottom line returns. Think about asset A that has a return of 8% and a volatility of 15%, which has a risk-adjusted return of 40%, which considers the risk-free return of 2%. Asset B has a 6% return and a 10% volatility and also has a 40% risk-adjusted return. So when you put those two investments together, your average return is now 7%, but your volatility drops to 9%, and your risk-adjusted return actually increases, in this case, to 55.6%. So purely by just putting two unrelated sectors or unrelated assets together raises your risk-adjusted returns. So the bottom line, predicting rotational shifts in the market is basically beyond the scope of this newsletter. Our goal is simply to spread exposure across as many sectors as possible to increase risk-adjusted returns. Now, one thing I will add to this, I do include ETFs in the analysis, and one thing great about ETFs is that most of them, not all, but most of them do not have any direct correlation to a stock. Therefore, they don't have earnings announcements. And you can find several, like a Bitcoin ETF, a China ETF. There's the Volatility Index ETF. There's others that aren't directly tied to any specific sector. So I like adding ETFs into the mix because it does give you a broader diversification. So I've showed you kind of my basic strategy around how I select stocks. And just to be clear and to repeat myself, I'm really focused on stocks that have strong underlying support, generally with these simple moving averages, but also with an upward or downward trend line breaking above, of course. So the next question would be, okay, how is that working? Now, I have talked about what the total returns are, but let me really kind of dive into a very detailed analysis that I've started to complete over the past 10 expiration cycles. So this shows a list of these stocks that were placed in the newsletter 4 weeks prior. Okay, now the newsletter is published on the weekends, and every trade on the watch list or every stock on the watch list is based off the previous day, the previous Friday close. Now, I have captured option prices and how that performed as well, but my focus here is simply on the stock gain percentage. The options is something separate and probably way more detail than I want to go through right now. In terms of the detail on this, every stock on the weekly watch list, which would have been 4 weeks prior, is included in the data. For this, which you see here, I have assumed a $10,000 stock purchase average, so that rounds to the nearest 100. So you do end up with a pretty wide range of investment levels from $7,000 up to $13,000, and that's just kind of what increments do to you, since you are forced to make trades in 100 share increments. And all data is based on the previous Friday close prior to the Monday entry for stock and option prices, and these are the same prices that were listed in the newsletter that week, and of course that's compared to the price 4 weeks later at expiration. in terms of the performance summary, the total of all these stocks represented a gain of 12.5%. Now that's over 4 weeks, so a little over 3.1% per week. The actual trades that I placed are highlighted. There's 5 of them. Those actually did 8.4%, or just over 2% a week. Now, if you'll notice, I traded this stock called Antero Resources, and that happened to be the worst performing stock out of all 19 on the list for that week. So that's really the biggest reason that my performance was not great compared to the total list. But I did have a couple big winners. The SMR symbol, which is NewScal Power, did increase 35.3%. So, I did have a nice winner there, but, the big loser on Antero Resources kind of negated that a bit. But this also kind of highlights kind of the range that you're going to see over a 5-stock selection cycle. You can see here the range is from a negative 21% stock return to a positive 35.3%, and then several in between. And it is important to note that the S&P 500 for the same 4-week cycle was at 3.5%. So clearly we have a very positive market environment looking backwards. But the actual trades that I placed, beat the S&P 500 by more than 2 to 1. And looking at the total stock list, it was, even better than that. Now, a couple of extra comments. This analysis began with the May 23rd expiration cycle, and the same analysis has been completed ever since. So I've now got 10 total weeks of data. And the whole purpose of this analysis is twofold. One, it forces accountability, right? I am accountable to my subscribers of the newsletter. And the other key purpose is continual learning. My goal is to consistently beat the S&P 500. And if my actual performance on the broader stock list or watch list is not accomplishing that, then I need to go back to the drawing board and keep continually tweaking the strategy until I can consistently do that. But so far, so good. I'm extremely pleased with the results that we've seen so far. Now, one more point to add to this is that I by no means expect that this kind of performance will continue indefinitely. I think it's been working out extremely well, but I make no representation that these same results will be happening into infinity. So as I mentioned, I've been completing this analysis for now 10 weeks. And here is a summary of the performance over those 10, and I say 10 weeks, that's 10 option cycle expiration weeks. So going back into May, you can see the performance was 10.4%. In June, it was 9.7%. And then for the entire period, including the 4 weeks of July, the total for all 10 weeks is a 10% average stock improvement. Now, again, that's a 4-week improvement, or 2.5% per week. Now, you can see how that breaks down in the various different sectors in terms of the percent stock gain. Now, listed below that is the stock gain percentage. So 76% of the stocks on the watch list have ended up higher than they did when the watch list was published. So you can note the comments below. So once again, every stock on the weekly watch list is included in the data, and all data is based on the Friday close prior to the Monday entry compared to the Friday close 4 weeks later, which would have been the expiration date. By the way, you may have noticed that I showed the watch list percent gain at 12.5% on the previous page, but I'm showing it at 11.9% on this page. The difference between the two is that on the previous page, I was using it at the increments that were listed, whereas this percent gain is just a pure average of all the different ones, which basically assumes the same investment level for each stock on the watch list. So that is the difference between those two numbers. So let's move to the final section in this video, which I'm entitling Play It Smart. And in this section, we'll talk about the expiration cycle, we'll talk about lot sizing, and we'll finish up with trade management, which, by the way, trade management is pretty much minimal, but there are some techniques that I do recommend. Okay, we'll start off with the option expiration cycle. And this is a larger slide of something that I started to review earlier, but it's definitely worth repeating. So I do like to leverage a weekly options expiration cycle so that I am trading literally every Monday, and every Friday I have something expiring. Okay, so this August example provides a good way of highlighting this. So if I'm opening a trade on August the 4th, that would be with weekly options that expire on August the 29th. That's always going to be 4 Fridays from the open date. And you can see how this progresses through to the September 5 expiration and the September 12 expiration. And then for the September the 19th expiration, that would actually have monthly options included in it. So I'm going to just throw all the weeklies and the monthlies into the analysis and choose the best ones. I'm going to slightly favor the monthlies because this is the only time to trade them. But quite frankly, monthlies have broader bid-ask spreads typically, and they also have larger increments between the strike prices. So it is actually a little bit tougher to find a good trade with monthly options, but because they only come up once a cycle or once every 4 cycles, and sometimes only once every 5 cycles, I do want to favor them on the right that third Friday of every month. Now, when we get to talking about the estimated optionable stocks, we're basically looking at a universe of about 6,000 stocks, of which about half have options. Okay, so of the 6,000, there's between 2,800 and 3,200 with listed options. Now, this is a pretty broad ranges because the number of stocks is constantly changing, but you get the idea. When you look at the stocks with weekly options, it drops even further. About 1/4 of the companies with options actually have weekly options. So just so you know, we're basically looking at a universe of 60 to 70 or 600 to 700 stocks. Now, this does not include ETFs. And on any given week, there are more than 100 ETFs, and because they don't report earnings for the most part, that just adds to the list of weekly options that are available. Now, when I say that they don't report earnings for the most part, you do have to watch. This is kind of a new trend, but there are ETFs that are focused on stocks like NVIDIA or Tesla or MicroStrategy. So you do have to be careful that even though they don't report earnings, they are closely associated with stocks that report earnings. So you have to treat them the same. Okay, let's now focus on lot sizing. We'll start this exercise by looking at the trade level exposure limit. And the way I calculate this is I start with the total cost of the stock minus the option premium received, which then gets me to the trade lot size. So as an example, let's say I have a $4,000 cost of stock. Now this could be 100 shares of a $40 stock. It could be 200 shares of a $20 stock, any combination that gets you to $4,000. Assuming about a 7.5% total option premium, which is about average, would be about a $300 option premium, which then makes my trade lot size $3,700. So now let's look at how that works across a broad range of investment capital assumptions. And we're going to start all the way off on the far right. And this is actually what I think is the ideal situation. In this scenario, we have a $200,000 investment capital level. We'll talk about the portfolio level exposure limit in a slide or two, but it's basically we want to have no more than 75% of our total capital invested at any given point in time. And on a $200,000 account, that would be $150,000. Our trade level exposure limit is about 5%. Now, ideally, we want to have 20 stocks in our portfolio at any given point in time, which gets you to a 5% investment level. But you can see that you need a pretty large capital account in order to do that. So I do endorse broadening that range out to about 10%, actually to maybe as much as 12.5% in terms of my trade level exposure limit. So with that in mind, I'm looking at the number of stocks per week in total of being 5 stocks in any given cycle and 20 total. My average trade lot size would be $7,500, which then takes me to the top of the stock price range at about $115. Now, I told you that I'm doing searches based off of a range of about $7.50 all the way up to $120. So I wouldn't be afraid to do a $120 stock here. But, kind of forcing the math to work, you get to about $115. Now, let me go ahead and just jump to the other end of the range. Let's say you have a $15,000 capital amount. 75% of that gets you to $11,250. Your trade level exposure limit would be 12.5%. Now, this is a little bit higher than what I would normally recommend. You'll see on my risk rules, I have the range between 5% and 10%. Of course, this would be a little higher than that. The number of stocks per week in total would be 2 per cycle and 8 total. And then the average trade lot size would be $1,400. And you're then looking at the top of your stock price range to be about $20. Now, I'm going to just drop in these middle areas here because you can see how they range across. But, these numbers are not hard and fast, but, you can see that how I'm thinking through this. And as we get through the individual risk rules, I think you'll start to see why each of these are important. The final topic of this video and this section is on trade management. So I generally advocate doing very little when it comes to trade management. However, there are some scenarios that are essentially forced upon you. There's really just no way around them. Now, backing up just a little bit, I've watched a number of different stock option covered call type videos. And I mentioned this a little bit earlier in a different context, but most of those begin with the statement, if you think that, and then, goes into an action. One of the things that I am very big on when it comes to this strategy and any other investment strategy is I try to take the if you think that out of the equation. I want to have very firm decision rules that says that when this happens, then I'll do that. Okay, and so that's basically what you're going to see with trade management. And as I said, I'm generally not going to do anything unless I am forced to. So when you look at the trade management rules, there's really 5 different scenarios that I'm going to cover here. The first scenario, and I've got it down in a green box, is an early call. And this is basically when the stock is called away prior to expiration. By the way, this is the best case scenario. You basically closed out the trade early. I've seen these things closed out as early as 2 weeks prior to expiration. But the trade's over. You've basically got your capital back. You could open up another trade if you wanted. But good news, the trade's over. Now, you do have that naked put that's sitting out there. And, I'm going to go ahead and just try to close it if I can get it closed for a very small price, like a nickel or maybe a dime per contract. But otherwise, I'm just going to wait for the put to expire. Now, the only reason I would try to close that out early is because it could reverse significantly and go back the other way, and in which case you would clearly have wished you had closed it out. But that's actually quite rare, so I don't push it if the price is over, a dime per contract. The opposite of that would be scenario two, where you are assigned a put early, or you're assigned extra stocks because the price is below the put strike price. In this case, and I do get, I trade with Fidelity, I get emails that tell me that expirations and assignments have occurred. When I see that, I'm going to go in and immediately just sell all of it. I'm not looking to have twice as much stock. We don't want to see this happen, and it doesn't generally happen as an early assignment, but it does happen from time to time, in which case I'm going to sell all shares, and again, I'm going to look to close the naked calls for that nickel to dime range per contract. And if I can't get a cheap price like that, then I'll just wait for expiration. Okay, so those are kind of the early situations. The next three situations occur after expiration. And so scenario three is the stock gets called away. And this is the simplest of all of them because number one is the best case scenario, and your position is closed at the maximum profit and absolutely no action is required. You are clean, all your the three legs of the trade are off the books, and you're ready to go to do the next thing. Scenario four is when the options expire and the stock is kept. So obviously the stock price is in between the call strike and the put strike. Now, in this situation, I'm going to just look at the chart. I'm going to look at the support levels. I'm going to kind of apply the same filters that I apply for every other stock. And if it kind of meets kind of that support threshold, I'm going to go ahead and trade it for the next cycle. I'll tell you, I've just run into this several times in the last few weeks because I'm going through earnings season right now. I've had several stocks that I would have kept, but were then going to have an earnings announcement within the next cycle. So in which case, of course, I'm just going to close them out. And then the next scenario is stock assignment. And of course, I got this one considered red as well. This is when the stock price closes below the put strike and I'm assigned more shares. Now, as with scenario four, I will look at the stock to see if I want to keep it. And if I do, I will very likely sell the half that I just got put to me, roughly half, and then maybe keep the rest. That's pretty rare though. In most cases, I will just sell it all, close out the position, and move on to the next thing. Now, in terms of the scoreboard, I just put this up here just to give you a bit of an idea on how often these scenarios happen. And this would be literally looking at scenarios 3, 4, and 5. Well, no, I guess it would be all 5 of them. But anyway, stocks are called away about 52% of the time. Stocks are assigned about 33% of the time. And we're keeping both options, or we're keeping the stock with both options expiring about 16% of the time. That equals 101%, which is due to some rounding, of course. And this is based off of 331 trades that have been closed through July the 25th of 2025. Now, I will tell you, and I mentioned this a bit earlier, I do have very tight, not very tight, but tight, um, near the money calls and puts. And so that's why there's quite a bit of stocks being called away and stocks being assigned. If you loosen that up and go more, out of the money, as we discussed earlier, these numbers will go down quite a bit. But I'm very comfortable at this level. I do feel like I may want to loosen things up a little bit, but overall, I think this is a good result. Okay, the summary for video 2. Remember that we went through these 3 areas. The first is to play the odds. We are going to sell premium. We are going to be the casino or be the banker. We talked about how to construct a trade, which is buying stock in 100 share increments and selling a call out of the money above and a put out of the money below. And we went through some of the pros and cons on where to place the optimal strike price of the calls and puts. Also went through the stock picking criteria that we use and stressed repeatedly how important picking strong quality stocks is to making this strategy work. And a centerpiece of that is to pick stocks that have strong support versus looking for these high flyer stocks. And of course, we are going to avoid earnings announcements, and we are going to stay as diversified as we can across sectors, price, and volatility. And then we finished up talking about kind of how to play it smart and how to manage the trades. We talked about this weekly expiration cycle. We talked about lot sizing, and then we went through the various different trade management tactics. Dual Edge Research offers 2 powerful newsletters with one simple deal. This video has been about the Bull Strangle stock and option newsletter, but we also offer the Smart Spreads commodity futures newsletters. You can get both newsletters for the low price of $49 per month, with deep discounts available for 3-month, 6-month, and annual subscriptions. The annual subscription is a 35% discount, and for a limited time, you can get your first month for just $1 by using the coupon code on the website. Go to bullstrangle.com/products to purchase.